Good afternoon. Today we're going to talk about hurricanes and how they impact the market. I started thinking about this topic when the hurricane kind of nearly missed the East Coast and kind of hammered the Bahamas, and how the market might react to some of that. So let's just go over some data around hurricanes. June 1st to November 30th is hurricane season, peak being mid-August to October. So we're kind of in the midst of it now. September is the prime month for hurricanes. A major hurricane, by the way, is defined as level 3 and higher. So there's an average of 10 storms a year. About 6 of those storms turn into hurricanes. About 2.5 of those storms each year turn into major hurricanes, level 3 and higher. There are 3 major hurricanes that sweep the United States every 5 years. So a lot of the storms just kind of get trapped off the coast of the United States, but 3 major hurricanes every 5 years. And the major impact on the states, the number 1 most impacted state, you can probably guess, is Florida. I was a little surprised that Texas is the 2nd most impacted state by hurricanes. Number 3 is Louisiana. Number 4, North Carolina, which is actually surprising as well. So we have lots of data around how the market responds. It's interesting, probably what you'd expect. Stocks like Home Depot and Lowe's and kind of home building and reconstruction stocks performed very well after hurricanes. We're going to show you a chart now that shows exactly how they performed. And what you'll see is that Home Depot, right, after Irene, 22% tick up, right, within the 6 months after the hurricane. Lowe's, you can see similar tick ups after each of those hurricanes. Generators from Generac, Eagle Materials, Quanta Services, all these tick ups from all these hurricanes, right? So the average of all of those outperformed the S&P by nearly 1/3, right? 12.5% S&P performance over that time period versus 16 for these construction stocks. So then here's the companies that actually had poor outcomes following the hurricanes, including American International Group, AIG Insurance, that makes sense. ExxonMobil, hard to dig oil out of those offshore wells when you've got the hurricanes going on there. Halliburton as well. General Electric, probably related to the oil fields, as well as maybe some of their financial services they provide. So interesting reaction in these stocks. It's actually significant, and that's a significant bump. Maybe you'd be better off just acquiring those stocks each hurricane season and holding them for that time period. But what's interesting now is we're going to show you a graph on how Home Depot actually performed during that period. So while the stock jumped up, look at this chart on performance. You'll see that the revenue for Home Depot is kind of choppy and consistent. It had actually nothing at all. You don't see any major blips related to the hurricanes. You don't see any significant impact at all on the revenue related to hurricane activity. So this is consistent with a long-time theory of mine. In the short term, markets don't react to the performance of companies. In the short term, news causes the market to react. Stocks are disconnected from performance of the company in the short term. Over the long term, we would see a trend towards consistent performance or value relative to the performance of the company. But in the short term, stocks react to news. And this news may actually drive stock growth inappropriately, inconsistent with the actual data on how the stock performs during that time period. So it's interesting kind of statistics to think about. I hope it's helpful.